Happy Friday. And finally, after a couple weeks of some brutal news, we got some good news this week, and it led to mortgage rates improving, albeit slightly. As of this morning, the 30-year fix opens at 6.85, down from last week, 6.87. And the narrative around why rates improved is really a gamut of information that hit the markets this week. First being consumer inflation. We had both CPI, so Consumer Price Index report, show both headline and core coming in below expectations. And there was a ton of fear walking into this inflation report, as it was for the month of May. As we know, the tariffs had been in place, and the expectation was those tariffs were going to have significant impact on inflation data. Well, the narrative was flipped on its head, and we actually saw inflation cool at a bigger clip than expected, followed by yesterday we received producer price index, so the wholesale side of component, which also showed some steady incremental decline. So really, again, where the market was concerned tariffs were going to have a negative impact on inflation, it had the exact opposite, and bonds responded positively. On top of that, continued claims in the employment sector showed more jobs being lost. And ultimately, we saw some of the highest job losses since 2021, which again, the market is acutely attuned to due to the fact that the Fed has made this narrative around we need price stability, inflation, plus maximum employment. And with inflation showing moderation coupled with heat coming to the labor market, the narrative now becomes, hey, when will the Fed cut? We know the Fed's meeting next week. It is unlikely that we will see a rate cut of any magnitude, but I'll be very curious to hear what Jerome Powell and the rest of the committee has to say. And here, again, where it is currently looking to be a long shot that the Fed would cut next week, with this new data and the potential and the China trade deal on now kind of the talking block, there is reason to believe that we could potentially see a rate cut next week. Now, again, it's a long shot. This is me speaking, not data that we're seeing. But again, I personally would not be surprised if we saw, a sharp course correction next week. But that's wishful thinking. Let's get back to it. With this said, as we saw rates kind of pull back, and there's definitely appearing to be more room to the downside, the thing we need to be doing now and communicating to our clients is we see an increase in inventory. We see buyer activity. It was taking a little bit of kind of a backseat with rates kind of in that high 6, low 7 mark. Well, with rates moderating, inventory heating up, we're past the spring buying market. Now is the time to act. Engage with your clients that were pre-approved before that said, hey, we're waiting. Clients that maybe were kicking tires a few months back. This is the time to take action before the real chaos continues to ensue. As again, we expect to see a very different rate landscape here into the conclusion of 2025. As always, if you're needing specific scenarios, scripts, whatever it may be to help move the needle in your business, I would love the opportunity to help. Do not hesitate to reach out. We're around, we're here, and would love the opportunity to serve you and your clients. If you find this information valuable, please forward it to a team member, forward it to a client. And as always, if you like, comment, subscribe on the YouTube page. It helps us get this information out to as many people as possible. As always, let's make it a fantastic Friday and an even greater weekend. Thank you.